In this video, we'll be talking about the business cycle. The business cycle refers to changes in output or GDP and employment over time. The economy naturally cycles through periods of economic growth and periods of decline. We're going to have recessions, whether they're short or long, and then followed by a period of growth. The economy is going to be doing better. Real GDP might be increasing. The business cycle refers to those short-run fluctuations in both output and employment, where we're producing more or less GDP, the number of people working, the number of people looking for jobs is changing. In the long run, though, economies follow a growth trend where output and the standard of living is going to actually increase over time. When we look back several decades or hundreds of years, thousands of years, we see that our standard of living is significantly better now. The amount of stuff that we're producing per person is proportionally greater. This doesn't mean that every year is better, every person is doing better off today than they were last year. It just means that over the long run, the amount we're able to purchase, the general average standard of living for our economy is going to be increasing over time. In the United States, there was a major recession from December 2007 to June of 2009. This is often referred to as the Great Recession or the financial crisis of 2007-2009. It started because there was a lot of investment in real estate market. Home mortgages were at an all-time high, housing prices had peaked, and people generally treated this as a safe investment. Investing in home mortgages or real estate tended to offer modest, steady growth over time. There was a certain level of risk, but it was generally deemed safe. Many investors were participating in what's called mortgage-backed securities, where they were purchasing a small piece of a large group of mortgages put together. The idea was if we diversify our mortgages, we have a lot in the same pool. If one or two of our homeowners misses a payment or doesn't pay it back, it's not going to affect our overall investment too much. They're trying to lower risk through diversification. And since home mortgages were already considered a relatively low risk, it was considered a safe investment. However, at the end of 2007, when the housing bubble burst, home prices dropped rapidly. People started foreclosing on their houses at alarming rates, largely because they owed more money on their house than what it was worth. And so these investments that were thought of as safe were no longer safe. Financial markets froze up. There was a liquidity problem, right? A cash crunch. And so it caused a long, deep recession in the United States. This was actually surprising to a lot of politicians and investors. People didn't really think we could have a long, deep recession like this any longer. They thought we had fixed the economy, perfected things, fine-tuned it. Sure, we were going to have some short-run fluctuations, some small, brief recessions, but generally, people didn't think we could have a financial crisis like this. There are many new regulations in financial markets after this recession. Maybe this will be the thing that fixed the economy, prevented severe recessions, but we'll see, right? Only time will tell. GDP actually grew from June of 2009 through March of 2020 when a global pandemic hit. COVID happened. So did the US have a recession because of the COVID pandemic? We'll talk about this throughout the semester. We'll get into more fiscal and monetary policy and how that may have slowed down or increased the recession or increased inflation or fixed things. So we'll look at some different policies that actually had an impact on the real GDP because of COVID. But definitely, March 2020, we had a decline in economic activity. When we're talking about the business cycle, we really are interested in real GDP over time. We're going to have a graph with some up and down bumps, but you're going to see an overall trend where it's increasing over time. A peak refers to the end of a growth period and the start of a recession. This is going to be the high point on a curve, relatively high point. So you can see on this graph here, this blue line, GDP is increasing over time. Once we hit a peak, it starts to decline. right? Real GDP is going down. Then we hit what's called a trough, or the low point on the curve. This is the end of the recession and the start of growth. At the trough, real GDP starts to increase again till we hit another peak, another trough, so on and so forth. Because we have this growth trend where we see the average is going up over time, that actually means that our periods of growth are longer or larger than our periods of decline or recession. Recessions tend to be temporary. Once they end, the economy goes back to those levels and continues to grow. So a recession or a contraction is any time there's a decreasing level of real GDP. An expansion or a growth period is any time we have increasing real GDP. And the long-term trend that we've seen is that this is going to grow over time. We're going to have longer periods of growth than we do recession. So we had a severe recession from 2007 to 2009, but then the economy grew for over a decade after that. We had a much longer period of growth than we did decline. This graph is showing expansions and recessions in the United States between 1960 and 2010. This is 50 years of the business cycle. The green lines, the green bars, are trying to highlight a period of recession. It's not always obvious or easy to detect a recession on a graph of this scale, partly because our recessions tend to be much smaller than our periods of growth. This is real GDP, which means we've adjusted for inflation and other price changes. And so you can see that our real GDP was around $3,000 in 1960 and up to about $13,000 in 2010. So we have this growth trend. We're producing a lot more stuff over time, even after we account for price changes. We're going to look at the effect of government policies, both fiscal and monetary policy. We're going to look at how businesses try to continue growth and keep the economy at an equilibrium. And we're going to see sort of this process where the economy cycles through expansions and contractions, but still has this overall growth trend in the future.